Good morning. For several weeks now, the European equity markets have strongly suffered due to a very difficult environment. We thought it could really make sense to organize this webinar to share with you our own views on these markets. Also, we asked Beryl Bouvier-Dunotat, who is the Deputy Head of Equity at Ophi Asset Management, to share with us her vision on the market and explain us why the impact investing approach could help reconsider the European equity. Good morning, Beryl. Thank you very much for being with us this morning. So in this context that I've just described, could you please give us your thoughts?
Yeah. I will give some points, on the market environment. Global growth has been revised down to plus 3.6% and could even slow down sharply, more sharply, due to lower money supply growth. Inflation is a concern everywhere. Lingering supply chain disruption and energy costs are upside risk for inflation. We are going to experience more regulations and bigger government spending. According to IMF, 2020 experienced the largest one-year surge in debt since World War II. And global debt, as a percentage of GDP increased plus 28% up to 256%. But inversely, the gross investment in the last decade declined by 15% in Europe and 27% in the US. Bigger government spending will support sectors like defense, energy transition, infrastructure, automation, and so on. Currently, the stock market and European equities are close to historical lows. The growth part of the equity market was very weak in the past months. The derating of cyclical parts was even more severe. They are trading at past recession lows. Now, forward Ps are down more than 30% compared to 1 year ago, at a level below the 20 years average historically. At the corporate, so now valuation becomes much more attractive for long-term investors. At the corporate level, the earnings season, which is almost complete for the Q1 result, was very strong. The EPS revision turned to be positive in the Eurozone, and margin profit delivery were much better than feared. The last but not the least, the investor sentiment with respect to equities is very downbeat, with an equity exposure to asset allocation which is very low. On this slide, we wanted to show you that the European equities is not only about domestic revenues. You can see that the percentage of diversification is very high on the stock 600 in Europe. On the right side, you can see that the earning revision for European stocks are still positive compared to other countries.
So, Beryl, I have just one question. In terms of SRI, according to what you just said, it seems that this SRI environment has changed a lot, and maybe for various reasons. Could you please give us some ideas on this topic, please?
Yes, of course. The big change is that sustainability is a long-term trend in finance. You can see on the slide, the chart on the left, the growth in asset under management is being driven by both large increases in sustainable funds, but also a large portion of fund launches coming with ESG investment strategy. So we have seen, steady inflows over the past few years, even in months where the broader market has seen significant outflows. This has contributed to a large rise in the percentage of assets under management. And you can see on the right side that even though Europe has the largest proportion, countries or regions like the US and Asia is improving a lot. Looking at sustainable investment, there are a lot of supports. You know, the first one and the biggest one is the European Commission engagement to net zero emission trajectory. You know, it is setting, it sets, you know, some package about renewable energy directive, circular economy, and so on. ESG regulation and frameworks are pushing for more sustainable investment, like the SFDR, the taxonomies, or a framework like the SDGs. But sustainable is not only about, you know, responsibility, it's also about economic opportunities. And we have seen, for example, that meeting the climate goals will need more than $6 trillion investment. On the bottom side, more and more companies are pushed to deliver ESG objectives and set up new governance with new ESG criteria. So for sustainable investment, there are some hot topics, like, for example, energy independence. The REPower EU plans to phase out from Russian fossil oil imports. Biodiversity is another topic. And human capital is a growing topic, as maybe the new E.
I have a question. So in this very supportive context, do the investors look more for alpha or for impact, according to you?
I believe, you know, impact investing is a good response for investors, because this investment approach has the intention to seek and to create both financial return and positive social and environmental impact. That should be measured at the end. And usually, this investment approach is commonly compared or aligned on the SDGs. So from the positive externalities, we also integrate the negative externalities, which is a way to monitor the risk in the investment approach. So our stewardship approach is investing in companies that is supportive, support positive impact, while reducing negative externalities through best ESG practices.
Okay, so now more concretely, how do you implement this vision, the market vision, the recent development in terms of regulation in the portfolio management of your funds, for instance, of course?
Yeah, just to remind, you know, the Act 4 Positive Economy Fund is really, has the focus to invest in the positive economy, supporting companies which are able to deliver positive social and environmental impact on the SDGs. So commonly, and today, our position is around 4 themes: the energy transition, which is a big overweight in the portfolio with 38% exposure; preservation of natural resources, which is the second big themes; and the last 2 are more about social impact around healthcare, well-being, and social inclusion. Here you can see, you know, some stocks we have in the portfolio. So Saint-Gobain is a building product company, well diversified. Acciona is a pure play on renewable energy, which is going to double its installed capacity by 2025. And the other company, for example, are clean tech alternatives, which are gaining and traction due to their, I would say, competitiveness compared to fossil oil. We have on the second pillar, some company, big company around the circular economy and waste management, but also technology which are very interesting, like NX filtration, which is a leading water treatment technology. And on the last 2 pillars, we are invested in big company in the nutrition area, or Novo Nordisk, for example, which is a leading company in chronic disease like diabetes and obesity. Here you can see our exposure, biggest exposure to the SDGs, and you can see that we have the biggest exposure to SDG 9 and 7, which is about infrastructure and reducing, CO2 emission with renewables.
Could you give us maybe some concrete business impact of your activity?
Yeah, so every year, as we are impact investor, we have to measure the positive impact of the portfolio. And here you can see around the 4 themes of the Positive Economy Fund, the positive impact of all the stocks we have in the portfolio. So it's a question of CO2 emission avoided. It's a question of waste or water treatment. And it's a question also about beneficiaries to people to get access to a healthcare product or internet or inclusion.
All right, just to come back to my previous question, we were talking about, of course, the choice of investors between alpha and impact. So you gave us some impacts. Now let's talk about the performance of the product.
Yeah, so the performance since the launch is still positive. Since the beginning of the year and even last year, at the end of last year, we have seen a huge rotation on the market in favor of the value stocks, in favor of the banking sector, but more about, the energy sector, which has been enhanced by all the geopolitics problems. So growth style, cyclical exposure didn't benefit to the portfolio, but we are more confident in the coming quarters to this, I would say, lower underperformance of the growth style.
Okay, Barry, thank you. And so, just to conclude, your outlook.
So the outlook for Europe, is still positive, and with the target to develop this big removing planet warming carbon dioxide from the air. So there are bigger challenges here. Also, we have a huge economic opportunities thanks to green capex, which is really big. And also, we have new companies, I would say innovation, which enhance also what we could consider the clean tech ecosystem. And at the end, the outlook is also positive, not only for the energy transition, but what we call a just transition, looking at companies which make positive contribution to more inclusive growth.
Barry, thank you very much for this positive message. I would like maybe to give you our next dates of our next webinars, and the 2 next one will be dedicated to fixed income and ESG, so a topic which is close to yours, on the 16th of June, and the last one in July on equity and climate. So thank you very much for listening and attending this webinar. Thank you.